Just a reminder, today's meeting is being recorded.
Hey everybody, this is David Blake with Tuesday Tech Talk. Missed you the last couple of weeks, but today we're going to quickly review the last couple of days, try to figure out what the market wants to do this week, and then we're going to look at some, obviously the support resistance areas, look at some of the different sectors I think could probably lead the market to new highs here, and then we're also going to look at how we come up with targets. So maybe you can do this yourself. Usually we'll work with stocks also. So to get started, last week we had a pretty volatile week. We saw the market basically sell off the start of each session. Dip buyers would come in, bring the indexes back to slightly higher, at least to the flat line each session. And then on Friday we got the jobs report that really shook things up. And of course the initial reaction was to sell. But surprisingly, investors came in, bought the dip again, and some of the indexes were positive, but we ended up bringing them back to the almost mixed at the end there, and kind of surprised a lot of people that the market would react to that. Basically, what happened with the bad jobs report, it probably took probably June off the table, most likely July, and at this stage, I really don't think that the Federal Reserve will come in September and try to shake things up before an election. That's not the way. They're supposed to be independent, but I don't think we'll see that. So we're probably looking at a rate hike now, sometime maybe in December or something like that. That's what the CME Group FedWatch has. They have about a 24% chance, I think, now of for July. So June's pretty much off the table. What we're going to do right now, we're going to look at the Dow Jones first, kind of see where we are since we haven't been here for a couple of weeks. Last week we were off slightly, but as you can see over here, we saw the Dow Jones. We're pushing 18,000 today, but we broke this descending trend line that went back to the April highs. We've climbed back above the 50-day moving average. Struggled with that all last week, but now we've broken above that pretty significantly, and that's bullish for the market. We're also seeing some positive momentum coming in. If you're following the market letter, we flipped the market posture May 27th to bullish. we'd been bearish all through this period. We always flip it on the Friday just for our discipline on that, and we ended up losing on the leverage trade a little bit for the last call, but not much, a couple percentage points. We did flip it. If you bought the leverage CTI ETFs on Tuesday coming back, you're already up about 3.5%, so we're making money up on that. But anyways, again, we broke this descending trend line. We're flirting with 18,000 today. Momentum's positive. We're not overbought on the Dow Jones yet. It's underperformed the Russell and NASDAQ in here. But we're also seeing something that we haven't seen for a while on the MACD long term. As you can see over here, we started to flip over on this throughout May, and we're about ready to give another bullish signal. Now, when the market, one thing I wanted to show in here, when the market made a high back here in April and also back here in December and November, occasionally I would talk about the number of stocks that we look at that are within about 1% of a new 52-week high or making a new 52-week high. Now this week, as of yesterday, we're right around 18-19% of the stocks that we follow are in the process of making, are within a 1% move. That means that it's a kind of a broad-based move. Now over in here, if you remember last fall when this thing was making new highs, we came on here a couple of times and we talked that we only had something like 14%, 14.5% of the stocks that were, when this thing was peaking over here, were within 1% of their new highs. On April, we got to about 25%, and right now we're April 2015, 25% of the stocks were making within 1% of new highs. So that shows you that we're getting a more broad-based move up here. This 18.75%. Stocks that are within 1% of a new low are only at about 7.92%. So that's also very good. Back in April of 2015, we were at around 10%. Back here in November, when we talked about this thing making this run, we had about 22% of the stocks that we follow were still within 1% of making a new low. That's not what you want to see when you're trying to break out the new highs. So that's a positive for the market. Here's another positive I like. This is the NYSE Advanced Decline line. This is also what we consider a leading indicator of market direction. As you can see on this, we're up here making new highs. In fact, this right around here, this is a whole string of new highs. We made a new high yesterday. The advanced decline lines are positive today. So that's telling you that we have a broad-based bullish move going on, and I think you can expect to see this thing work its way a little bit higher. In addition, we have an expansion of the NYSE new 52-week highs and lows. This is breaking up here. We had over 200 again yesterday. That's very bullish, and we're getting down here where we're only having single digits on the number of new 52-week lows. Again, that's bullish. Now, when we come up with a target, occasionally on the market letter, you'll see, if you read on Friday in the summary, we come up with different strategies for targets, where we think the market's ready to go. There's several ways that we come up with this. One way that I'm not exactly real wild about, but if we look at this as a Elliott wave, we think of this as the first wave, this would be the second wave. Okay, this is the third wave, this would be a fourth wave, and we're probably in the fifth wave of this move off the bottom right now. Now, one way we can look at this is if you take the move from the low here to the high, what that's going to do, let's see, 15,450 on the low, and we hit a high over here of about 16,510. That's 1,060 points. So if we consider this low over here from May 19th as the bottom of wave 4, that we would add this 1,060 points to that, and that's going to come up with a wave 1 target of 18,391. So this move that we're currently in, I think we could probably see almost 400 more points. Now, another way to figure that out is if you take this wave 1 here, the 1,060 points, if you multiply that by a Fibonacci retracement level of 0.382, that's going to give you 1,037 points, which we add. It's going to give you 183 points to add on to this over here. My bad again. It's going to give you 1,037 points, and that's also going to target 18,368. So our primary target on the Dow at this stage is somewhere between 18,000, say 350, and 18,400, and that would probably be what we could probably see over here sometime in July, maybe going into August. Now, if we really get things start to pick up, if you take this first move down here, the 1,060 points, and multiply that times 0.618, the secondary Fibonacci retracement level, that's going to give you 1,679 points to add on to that. And that's going to give you a secondary target on the Dow of 19,010. It may seem a little bit high at this stage, but it's something that if things really pick up, like say we get some where the dollar keeps on getting weak, that's always a possibility. That would be about 1,000 points from where we are, which is less than about a 4 or 5 point move. So that's a real possibility at this stage. But for right now, let's target in on the 18,350 to 18,400 as our primary target on the Dow. Okay, let's take a look at the S&P 500 right now. It made a new high for 2016 yesterday. We're up about 7 points today. Last week's market letter, I told you want to see if we can break through that 2005 to 2010. Okay, we've done that. 2105 to 2110. Okay, we did that yesterday. We hit 2111 intraday. Today we're at 2116. So we've taken out these highs, which is very bullish for the market. We're about 15, 16 points away from the old high, which was 2130. Let's see, the old high was 2139 that we reached last year. So what we want to look at on measuring this thing for a target, if we come over here again and measure this low I want to measure the low from here to here. Generally, you don't want to do that because you had a lower here, which kind of negates the the wave one action here. But anyway, for the S&P 500, if you take the low of about 1810 to 2111 up in here, okay, hold on. Okay, 1810 to 2025 level. I'm sorry. I mean, you're going to get a reading of 301 points, which when we add on to the low from the level wave 4 here on the S&P 500, that's going to give us an initial target off of the waves of 2139, which again comes into the old highs, which makes us think we'll reach that. And also, if you take that first move and multiply it times 0.382, the 301 points here, you're going to also come up with 2139. So that's confirming that with two different measures off of the S&P 500. If we multiply this move times 0.618, it comes up with a secondary target of 2211. That would be again, if we see the Dow making a run towards that, up through 18.4, we could possibly see the S&P hit 2200. I'm not going to bank on that yet, but I do think we could probably get through the new highs on that. So that's how we come up with some of these strategies. Now here's the NASDAQ. We'll take a look at the same thing on here. The NASDAQ, as you can see, is not quite as good looking a chart, but we've had a heck of a bounce off of this low from May 19th. We do have a descending trend line that it hasn't challenged yet. That's going to be just as soon as we cross over 5,000, and we're at about 49.72 today, almost flat, just up 3 points on this. And here's the line that's going back here from the April high. It's kind of where we're bumping up against here. But I expect this thing to probably chip away this descending trend line over here and make a run up here, probably to about 51.50. At least maybe possibly challenge the old high of around 52.18. But we are overbought, as you can see here on the 30-day stochastic and also on the 14-day RSI. And that's telling you that we could probably have a little bit of sideways before we make a run on this thing here. Now looking at the NASDAQ advanced decline line, you can also see that we're challenging the highs from back here in December. We took out the April high. This is all bullish. It means you have some good participation in this move higher. And also we're having some expansion in the new 52-week highs and lows with this. I'd like to see this get up a little higher, towards the 200 range, but we're about as high as we've been all year as far as new 52-week highs. So that's bullish. It shows that a lot of stocks are coming into that. Okay, now on the NASDAQ, as far as looking for targets, if we look at wave one down here, it goes from from about 4209. We'll call this the top of wave one right over here. That's going to take us to 4576. And that gives us 367 points on this rise for the NASDAQ. So if we go up here to the May 19th low for wave 4 and add that on, okay, it's going to give us a target of 5,045, which would be right around in here, which means we should take out the top of this wave 3 on here. Now, if we multiply, the Fibonacci isn't working as well with this because we had a little bit more of a pullback. If you do the multiplication of the 0.382, that's going to give you 140 points to add on to here. That first target would have been 48.18. It made that pretty quickly. And then if you do this, multiply this move times 0.618, you come up with 226 points to add on. And that gets you to 49.04, which we hit right over here. So that would have been the first target. This is the second target. Our third target now is at 5,045, possibly to 5,100. I think we'll hit that. We're a little bit overbought over here, as you can see on the stochastic, the 30-day stochastic, and also on the RSI. So maybe a little bit of back and forth trading on the NASDAQ would be perfectly fine. We also see that the strong momentum here on the 14-day, and also we have the MACD long-term has a bullish signal on that too, which means that the overall trend is going to be bullish. Okay, a couple of other charts to look at real quickly. Here's the Russell 2000. Another good-looking chart, broke through a descending trend line over here, came back and kind of bounced around the 50, and we took off again. One of the things I don't like about this is over the last 11 trading days, we're up 8%. If you're in the leveraged ETF, you've had you're up about 8 or 9% just in the last about 4 or 5 trading days. So a little bit of a pullback over here. You're way overbought. I can see this thing spinning its wheels. Today we're up 4 points at 1181. So we're going to challenge this area over here around 1200 probably pretty soon. That was the high from back in December. I don't see much divergence or anything in here. MACD is also bullish. So overbought, but like I say, if we can go sideways in here, I think the old high at 1295 from back here is probably going to be the short-term target on the Russell 2000. And you do want to see the Russell 2000 kind of lead the way with small caps on any kind of market rally. Another thing we've talked about in the past here is the Dow Jones Transportation Index. It kind of led the market lower, and now we've had a nice bounce off of the January low. Came down here, tested the 100-day moving average, and today we're up 110 points, almost 1.5%. So we've taken out this 50-day moving average, which is it's a good sign for the transports. We don't have, you're not overbought. You're only at 50 on the 30-day stochastic, which I like. You're probably going to move above that, which is also a bullish trend indicator. The MACD LT is also has moved bullish on this move too. So the support of the transports, we need that. Breaking this 50-day moving average could give us a run up to around 8,000, and anything above 8,000 is probably going to signal that could be what helps push this market up to about that 18.4 region. If you go back here, this is a weekly chart that I wanted to bring up on this. This is also another bullish sign. This is the 50-week moving average, and we broke that today too. So that's another confirmation that this thing should work its way up higher. This is the 100-week moving average, which I like to watch, and that is up here around 8150, 8200. So anything above that, that would take out this move from last fall, and would break the series of lower lows and lower highs. And I'd like to see that that happening here. That would kind of give a bell that things are going. So as you can see, regardless of what we're looking at, whether you're concerned about the elections or earnings or whatever, it looks like through the technical indicators that the market wants to go higher in here. We also have the CTI is going to stay bullish through about mid-August, which kind of coincides with what's probably going to be happening in the election. So you probably will have some back and forth trading at that point, but I think we should have a summer bounce in here. Also, we're getting some good things going here with as far as earnings go. With oil up here, we actually crossed above $50 today. That's bullish for the overall market, also for the energy and materials sectors. Now, the energy and materials sectors have been keeping the earnings for the broader market in negative territory now for 5 or 6 quarters, and we should start to see some estimates coming up for the second quarter and also for the third quarter. So if we can get some where earnings were down like 80% for the energy sector, if we can get that where they're only down maybe 10, 15, 20%, that could possibly give us a boost and break this string of negative earnings for the S&P 500 going into either the second quarter or into the third quarter. That would help support a little bit of a rally in here. As far as what could propel us even higher than the old highs, the valuations are still rich, so I wouldn't just go all in here. But I think if you're holding positions, I think you can watch them go higher. We're going to look at some of the sectors where I think I wouldn't be adding to positions here, but we'll look at that here going forward. Okay, actually over the last 1 month period, every sector is higher. The best performer has been the energy sector over the last month, going back to about right about here. We're up about 6.11% over last month. It's walking nicely up a ascending trend line. We're having a little bit slow down over here. Part of this was caused by if the Fed was going to raise rates, that would have strengthened the dollar, which could have seen energy probably fall down a little bit at that stage. But when they took the rate hikes, that bad job report, the dollar, as we'll look at a little bit, also kind of fell out of bed again, has weakened. That's going to help this. However, I'm not sure that we're going to see this make the old highs. If you go back, going back about to the lows of 2009, where we talked about this, where we broke the long-term trend line, came up, bounced off of it, and then broke lower again. Okay, we're coming back up this way, and it's positive. as you can see, you're having some profit taking going up here around this $50 with oil. And for whatever reason, I don't know that you're going to challenge the old highs anytime soon on oil. I would probably be holding to lightening up at this stage. I don't like, whether it was less driving or electric cars, whatever. But I think with the energy sector itself, you'll probably start to see some overweighting of alternate energies coming in here, and that would probably be the driver to see this thing move up higher. But as far as adding new positions to energy, I'm lukewarm on that. I don't like the up-down slope, and you're a little bit still overbought at this stage. Okay, what I do like better, I do like the tech sector. Over the last month, the tech sector is not, we're not far from a new 52-week high. As you can see over in here, we've also, it's run up about 4.62%. There is a little bit of negative divergence in tech, which kind of surprised me. So we're going to look at the Philadelphia Semiconductor Index next, which has had a heck of a run. But we are above the 50-day and the 200-day. Any weakness would probably be caught down here on the 50 in this upward trend line. So I do like the positive momentum that you see off the RSI, and the MACD LT is also bullish. So I think you can pick up shares of technology. Here's the Philadelphia Semiconductor. Look at this spike in this thing. Over the this is it's up 13.6% in just the last off this 519 low. So it's definitely overbought in here, but we are seeing some nice accumulation starting to come back in there. MACD is bullish on the intermediate term, and I'm not sure I'd jump in there right away, but the semiconductors look strong in here. If they get a pullback, you could probably buy those, and that's adding strength to the XLK, which is the technology ETF. Okay, here's another one I like, is the healthcare ETF sector. It's up about 4.51% over the last month. It's got a nice golden cross here with a 50-day crossing, a 200-day, a nice run into that. Good accumulation. RSI, the 14-day RSI is showing positive momentum, and the MACD has a bullish signal. So I think that can work its way higher. Another thing that's giving this a boost, this is the iShares NASDAQ Biotech ETF, which, as you can see, almost a triple bottom down here. And we've also seen it come up and break through the 200-day or 50-day and 100-day. We're going to come up here, challenge a descending trend line. It goes back, over a year, and then we'll run into some resistance here at this 300 level. It's off today, but that was because some big tech, I'm not sure which one it was, missed an earnings things. It fell off, but it's had a heck of a run in here. This is giving strength to the broader healthcare sector. I think you can buy some of these biotechs at this stage, whether you buy a basket or whatever, some of the bigger ones. I think this goes through here and works its way higher. Good accumulation, and that's probably an area that you want to go into. Okay, the next sector that we see in here is the materials sector. It's up 4.44% over the last month. But get this, from the lows down here in January, this thing's rallied 31% since January's bottom. That's a heck of a move, even with that move in oil. I'm not sure that, that certainly is getting a little toppy, but you do have a cross here of the 100 crossing to the 200-day. They already had the golden cross over here, but you are seeing this downward up-down ratio here. That was, again, caused by part of the, people thinking rates were going to go higher. If rates go higher, it's bad for materials and the energy, and that would cause some weakness in here. But I'm not sure I'd be chasing after the materials sector. I do like it probably better than the energy sector. So if we can cross through this descending trend line, you might get another little bit of a pop. But, again, a little bit of negative divergence on that. But you might see this start to pick up again now that the dollar is weakened. Okay, here's the utility sector. It's up 3% in the last month. It made an all-time new high on Friday. It spun its wheels yesterday. Today it's up again. It's 673. So part of the strength in this is people chasing yield. If we're not going to raise rates until possibly December, the utility sector can probably trade sideways. What I don't like about it is it's expensive. You do have some negative divergence in here on this new high. It's not confirmed by the up-down ratio or the 14-day RSI. So this is a non-confirmed new high. I think what you're doing in here is just probably more of the retail client trying to make just chasing yield, and that's probably not. I wouldn't be adding the utilities in here. If I have them, I think you probably stay in a range in here between this 48 and 50 for a little while, maybe with a little bit upward bias. But this negative divergence bothers me. I think this is a little bit toppy, and it's too expensive to be buying those right now. Okay, another sector that I actually like, it's gotten some bad publicity. This is the financial sector. It is up 2.44%. It ran up right over in this area when they going into the FOMC meeting. Higher rates obviously are good for financials, not only the banks but also for insurance companies and actually the broker dealers too. So we sold off over here after last week, but it rallied yesterday, and we're actually let's see here, and we're actually up today also. Not a lot, but we're up almost 0.25% at this stage. I think you're going to see the financial sector actually move up here, probably take out this descending trend line, even though the dollar is going to be weak and I don't see higher rates. Several reasons for that. You can see some good accumulation down here. We're not overbought, a little bit of negative divergence here. But I think that the banks are so cheap, and people don't want to be surprised where they stay on the sidelines with the financials. They know that rates are going to be going up soon, sometime towards the end of the year, and you might as well accumulate some of the bigger banks, some of the better banks. I wouldn't go all in, but I think you can add to some of these that breaks through this descending trend line, and you maybe go sideways to slightly higher over the next, for the next couple of months. And here you're starting to see some buying going into that, which was, due to the rate hike thing. But you're not seeing a mass thing. If the institutions were really nervous about that, you'd have probably seen this drop down and take out this low, which, if you buy it in here on 23.50, you may want to, if it breaks down from there, you might lighten up again. But I think you're going to stay on this thing and probably trade in the range on the financials. The industrials, again, this over here, you saw this area right in here, you saw the dollar started to strengthen here over about the last week or two, and we'll take a look at that in just a second. But if we're going to stay a struggling U.S. dollar, a weaker U.S. dollar, if rates aren't going higher, helps the industrial sector. You did have a lot of profit taking in this area when we thought that the rates were going to go up, and now that they're not, you're starting to see you'll see more accumulation in this, and you'll start to see this go sideways. But this helps the it's good for the multinationals where they don't have to fight with the currency trade-offs when they bring the profits back. So industrials can probably move higher over here. Again, a lot depends on what happens with the dollar. This is the UUP ETF for the U.S. dollars. You can see over here when this thing was rising, you saw the XLI industrial sector selling off. Okay, once they decided that we weren't going to raise rates last week, okay, boom, you saw this thing fall back down. Now, I think that you're probably going to be trading sideways in this area, which is down a little bit more today, but not much. You may zip back and forth, but this is good. The weaker dollar is good for the market. It's also going to help us, push out to new highs. It's good for emerging markets. It's also good for commodities. It's good for multinationals. So as long as these rate hikes are off the table, again, that's another reason that I think the market's going to move higher. And again, I would look at some of these emerging markets and some of the different commodities and things that you may not normally be into. I think you can probably make some money on those. Lastly, here we have, before I wrap it up and get some questions, if you want to start bringing those in now. This is the consumer staples. You're again challenging new highs. It's been kind of a sideways market since April. Part of that's because of the rates going up. Once rates go up, this is not a cheap sector anymore. We've talked about this several times. Where you're trading up in the low 20s on the consumer staples. Normally that trades at around 13 PE, but the race, the look for high yield is keeping this thing. So perhaps you trade sideways in this. I wouldn't be out there buying new stocks, but you take a look at companies like Procter & Gamble, Kimberly-Clark. You even look at some of cigarette companies, Philip Morris, Altria, things like that, some of the liquor companies, they do better with slow growth, and they also pay a good yield. So those might be some areas that if we're going sideways, you could probably get a decent dividend. I don't see much downside at this point on these things. And that sector's up over the last month, almost 1%. So in the weakest sector at this stage for the last month is consumer discretionary. It's up 0.26%. But it got killed back here when earnings started to come out. But a lot of this was due to some of the high-end retailers. I think if you stay with the discount stores like Dollar Tree, maybe Costco, things like that, some of the specialty retailers, things like Home Depot, Lowe's, Ulta, some of the ones I like in there, I think you'll do well. You can probably come up here and challenge this $80 mark, and things will look better. The stores like Nordstrom's and I don't know, Parisians and Tiffany, things like that. The high-end markets don't seem to be doing very well. We'll have to see how that goes. But again, I think this will start to improve going forward. And I've used my 30 minutes up, so I'm going to try to cut it out now. But again, I think things look pretty good. The indicators are telling me that we're going to probably move to new highs in here. I'm going to open this up for questions. What are the ticker symbols for the 4 leverage ETFs to use when CTI turns bullish? Okay, the bullish ones are, let's see here. You know, I don't have that right on me, but what I will do is, wait a second, hold on a second. Here we go. Okay, for the bullish ones, for the Russell 2000, it's URTY. For the Dow, it's UDOW. For the NASDAQ, it's T as in Tom, QQQ. And for the S&P 500, it's SPXL. We added these things on bottom on Tuesday. And the CTI, if you owned all 4 of them right now, off of that call, you're up 3.95% on that one. So for the year, you're still up over 30%, going long and short on those tickers. Another question over here. What about the defense sector? Okay, the defense sector is going to be part of the industrials, and it looks fine to me, especially with the weaker dollar. I know Martin Marriott, I think, some of these, they've been doing well. I'd have to look at the individual stocks on that, but the industrial sector, to me, as long as this dollar stays weak, I think you can buy those. If you have any stocks on individual stocks, we can take a look at those real quick. I didn't get any questions earlier to go to it, but we got one guy typing, then we'll see if we're going to wrap it up or not. ETF for silver, SLV. Let's take a look at that. Can you see that chart? Okay. No. Okay, I'm not able to get the chart up right now. I'm not sure what. I'm getting some error message on this thing. I can't look at thing. I tell you, I'm not with silver and gold both. I've been bullish for a while. I'm kind of backing off in that. I've kind of taken my took some profits in gold and silver. I didn't buy, but I would probably look at. There it is. That's for the. Oh, here we go. Here we'll take a look at silver right here. Okay, as you can see this, when they're looking at a stronger dollar or a higher dollar, they're starting to sell off here. Okay, you bounced up in here with the weaker dollar. I just don't see a lot of upside to this thing. You may get a trade up in this area on silver and gold, but again, you're probably going to see the rate hike coming in here, towards the end of the year, and that's going to keep the upside on the precious metals somewhat limited to me. So I would, if you want to trade it, I think you can maybe get some short-term rallies in here, but I'm not looking for silver to make any kind of move like this than what we saw, from the beginning of the year. Okay, earlier the CTI was expected to remain in bearish territory till August. What changed you like bullish? Okay, no, the CTI was scheduled to go bullish the first week of June. The reason we changed that, let me go back to the Dow, and I'll tell you why we changed this. And if the market letter comes out on Friday, we're expected to go bullish somewhere in this area. I actually thought we were going to go lower. But when the cycles, especially like for cycle A, B, and C, we reset at this point because we made a higher low. If you make a higher intra-week low, then you can reset the cycles if the market starts to move. Now, had we gone down here and taken this out, the cycles could have been extended into June. But right at this stage, we're bullish, and we're expected then to go bearish again in August. So this was, it looks for maybe, would we have gotten a summer bounce? I don't know. We obviously are. But this came back a little bit stronger. And when we made the higher low on the Dow and the S&P 500, actually on all the indexes, that made me reset it to on 527. And I talked about that on the May 27th Friday market letter. Okay, we're at about 12:35, and I like to keep it, I don't like to go any longer than that. So I'm going to go ahead and sign off. I have some questions for next week. Please feel free to email them in to the doc@marketedge.com. I appreciate you joining me. I hope you got something out of this. Again, I think we move higher for June and into July, and I think you can be looking at some of this buying the market in here. Thanks for joining me.